Hi, this is Randy Kirk, and I'm bringing you this month's edition of Following Cathie Wood. So Cathie Wood once a month puts out her report, and she analyzes every aspect of the markets. And you could certainly watch her report yourself if that would be preferable, but I try to do it a little faster than she does, and I add my own twist. Specifically, of course, taking into consideration Tesla and everything Elon Musk. So this is Randy Kirk, and if this is something you enjoy each week, please let me know that by liking, by subscribing, by setting up notifications, and also by commenting, because if this is not content you like, well, I'll try to do something else that is more to your interest. My attempt is obviously to do things that you're going to get some value out of. Okay, let's get into what Cathie had to say. So Cathie spent almost 1/3 of her entire 45-minute analysis talking about the failure of the SVB bank in Silicon Valley Bank. She was very concerned about it. She may have been only partly concerned and partly maybe a little happy because she thinks it's going to cause the Fed to wake up, and she feels the Fed has completely gone nuts with regard to these interest rate increases. She's been talking about that now for several months. Actually, I would say 6-7 months. She's been saying this is the fastest increase in interest rates in history, including during the Ronald Reagan years in the 80s when they were trying to break the 20% inflation rates. Never before in history, and as on a percentage basis, have we seen these kind of interest rate hikes. And it's very hard for companies and banks and others to adjust to these quick interest rate hikes. And that's basically what happened with SVB. SVB had very wisely 2 years ago invested in a lot of long-term bonds that were at 1.7% interest rates. That was a very good return for a bank to be able to get on solid equity or solid products that would meet banking regulations and whatnot on their depositors' money. And then they were out, of course, doing like everybody else, lending, hopefully smartly, to local interests, local companies, local real estate deals and whatnot. A lot of theirs were in the Silicon Valley, so they would tend to have been maybe some startups and some high-flying companies, but nobody's suggesting that their portfolio was overbalanced with risky type investments. What they did have was these 1.7% interest rate bonds, which over the course of the last year, as the Fed has gone crazy, well, those interest rates have gone up, which the value of the bonds has gone down because the interest rates that are now available are higher, with interest always going in the inverse of what the bonds go in terms of their value. So this portfolio of bonds, the value went down. And so you could sit there on the bonds until they mature, but these are long-term bonds. And you just can't, the SVB could not afford to continue to sit on these bonds. So they started looking for other ways to raise capital. They couldn't find other ways to raise capital, and they started having to sell some of these bonds at a loss. So when that happened, the chatter got going, and all of a sudden there were people that were looking to pull their deposits out. So the long and the short of it is this was basically due to the rapid increases in the Fed's interest rates, which made it impossible or hard for SVB to be able to reorganize their portfolio in a timely way, and they got caught in the middle. So what does that mean in general? Well, in general, it means there might be other regional banks that are in the same position, and some of those might have more risky portfolios in terms of startups and high-flying companies that might have issues in a recession. And she also pointed out that there's an issue with office space being empty in many, many regions. And so the owners of these office buildings have had to come in and renegotiate their mortgages, which has also put some downward pressure on the value of the assets of these regional banks. So this is another issue that could be hitting at exactly the same time. Now, this is a regional bank issue only, and Cathie said she would not be surprised to see some other regional banks in trouble, but it is not a big national bank, the too big to fail group. They have been required since the last the 2008 problem. These major banks have been required to pass stress tests, to have a tremendously varied portfolio, and there's a lot more scrutiny over exactly what they're doing on a day-to-day basis. So it's not going to be something that would start to really infect the entire banking world, but it could affect additional regionals, which could put downward pressure on certain aspects of the stock market, causing people to rotate out of financials and into things that are more solid. Now, you may have heard me earlier today, or was that yesterday? I can't remember, saying, well, maybe Tesla is starting to look like a more of a value stock. Nobody thinks Tesla is going away. Pretty much everybody thinks Tesla will continue to do fine in terms of sales and profits over the next several years. Lots of disagreement about whether that 50% per year increase will continue, or an increase of more than 50% a year in profits. But clearly, nobody thinks that it's going to be zero increase in sales or some decrease in sales. So there, all of a sudden, you might start seeing people that are going to look at Tesla as a value proposition, a good safe haven for cash during this period, where they might get, 4% on long-term bonds, 3.7 right now on long-term bonds, but they got no upside on those. Maybe some downside, of course, is always possible. But anyway, you could look at the situation over time and say, well, this is a good place to put my money because I might get a lot bigger return on shares in Tesla. So that's not something Cathie said. However, she did vote with her cash last week, and she put way more money in her ARK Invest funds. At least two of them, I think, maybe more. At least two of them, though, were purchasing on the dips last week at fairly substantial amounts. So that is, where we sit with regard to that. Now, other things that Cathie brought up, there's almost no growth in the money supply, and very, very low amount of movement of turnover in the money supply. Both of these would lead us to think you're headed for a situation that's not very good for the overall economy. But it's just one signal, but it's a signal worth watching. She did bring that up as something that we do need to be watching out for. On the other hand, as I also mentioned on Friday in my review of the week, the employment numbers were strong. Weekly hours were down just a tad, and the unemployment rate was up a couple of 0.2%. But that was because a lot of women started coming back into the workforce, which was not able to be covered as quickly. But still, big numbers: 311,000 new jobs last week. That shows a strong economy. Wages, however, were only up on an annualized basis at 2%. Which should make the Fed happy. So not 100% sure how the Fed will read all of those numbers, except that, as I've been saying for months and months, the economy continues to be way stronger than one might expect, given these interest rate increases. And it's really hard to see where the recession comes in when you've got 1.9 jobs out there for every one person looking for a job. All right. Finally, the commodities. If you guys haven't looked at this work that I did this morning with Joe, I'm always forgetting his last name, Munaretto. This morning, there's a video out with Joe Munaretto. You really need to watch this video. If you care about these kinds of issues, the financial issues that are impacting markets, impacting Tesla, impacting the future of the country, this was a fantastic interview with Joe where he talks about that inflation is over. It's at 2%. The Fed can relax. They can go home. It's done. And he proves it really, really well. I'm not going to go into all the details again. I'm just going to encourage you to watch that video. I will put a link in the description below so that you can find it easily. But I can't tell you, again, how important this is if you care about these kinds of issues. But commodities in general are down. Oil has been flat for a number of months. It's been going between $75 and $85 for Texas crude, but right now it's sitting at 75. So in general, that major important for inflation inflationary purposes, oil is in pretty good shape. Cathie pointed out that almost all, like corn, I mean, go down the list, copper, everything's down, silicon's down. Again, another 10% over the last 3 days, 30%, I think, from the top. So this would all suggest that the Fed can relax and go home. Anyway, she brought up an issue that I've never heard her say before, which is that she still believes that gold is the #1 way to evaluate whether there's inflation or not. And gold has been in a trading range now for a year. So that would suggest, again, that inflation is under control. Let's see. She also points out this historically large bond inversion where the long-term rates are lower than the high-term. I'm sorry. Typically, your long-term bonds, which are sitting right now at 3.7, would be at a lower rate than your short-term bonds. But right now, your short-term bonds are 100 basis points inverted. This commonly suggests a recession in the future, but they've been inverted for months and months and months and months. So it doesn't seem to be meaning that. I think what it really means is what we said before. The long-term bonds are a great way to look at what the crowd thinks is happening in terms of inflation. And the crowd thinks that inflation is at 1.7, according to this, because typically the 10-year bonds are going to be 2 percentage points over the inflation rate. That's what long-term investors are hoping to make, 2 percentage points more than the inflation rate. Okay. The bear market is getting long in the tooth. Cathie didn't say this. I picked that up in another resource, but this right now we're almost exactly at the average length of a bear market. Cathie did say that March, for some reason, tends to be the month where the markets tend to make a new trend. So this could be a time for a turn. It could be a time for a turn down or a turn up. It could go either way. Other people are suggesting, well, as what we saw before, was that a bull market within a bear, and so we need to go back and test the lows? Unclear. Again, Cathie didn't speak to that in terms of what she believes, but she did say she wouldn't be shocked at all to see a brand new long-term trend start in the month of March. Well, that about wraps up everything that Cathie said. I'm got another video coming out tomorrow, another video with Joe, and he's going to talk about the Optimus. And this is his specific area of specialization, where he got his PhD, not on robots, but in general on how to analyze human movement and human data, things like blood flow, or anyway, I'll let him tell you tomorrow. Watch that video for sure. And hey, listen, it's been great talking to you.